There are companies out there waiting to hand retail traders up to $100,000 in trading capital. They're called prop firms, but the capital comes with a catch. 95% of the people who take these accounts fail the initial evaluation stage and lose their funding within 30 days. These failure rates aren't an accident. Prop firms set strict parameters, specifically tight daily loss caps and rigorous maximum drawdowns. To hit the required profit targets under these tight constraints, traders are pushed to over-leverage their positions. This creates a psychological trap. You take a small hit, you panic, and you try to revenge trade your way back to break even. The rules directly weaponize human hope, fear, and fatigue against you. But a new category of trader is bypassing this trap entirely. Solo quants use modern no-code software to build algorithms that automate their edge in the market, removing human emotion completely. Trying to pass a modern prop firm challenge manually is playing a rigged game against an institution. To survive in this environment, you have to stop trading with your gut and let a machine execute the math. Algorithmic trading prioritizes flawless defense through a risk management overlay. Solo quants use background scripts called equity protectors. These AI agents monitor the health of a trading portfolio 24 hours a day, 7 days a week, without ever suffering from screen fatigue. This animated graph shows exactly how an equity protector operates. The line tracks a live account balance dipping downward. The exact millisecond the account threatens a 4% daily drawdown threshold, the script hard closes all open positions and freezes trading activity. By enforcing a strict automated cutoff, the system removes your physical ability to make an emotional mistake. It replaces a dangerous gambling habit with institutional-grade risk management. No-code AI tools can generate thousands of potential strategies in minutes, but if you trade them blindly, most will fail. They're often curve-fitted, meaning they only look profitable in hindsight because the software cherry-picked historical data. To find a strategy's true risk of ruin, quants use a Monte Carlo test. This visualizes a sequence of winning and losing trades. The test reshuffles them into random sequences, exposing hidden losses. If it survives, it moves to out-of-sample testing, shifting onto a timeline of unseen historical data to trade through past black swan events. Finally, surviving strategies are placed in an incubation phase. They run on simulation money in real-time markets, verifying that they perform under live conditions before real capital is put on the line. Exposing the math to this intense quality assurance process is what separates a fragile lucky bot from a robust institutional-grade algorithm.
Traditional manual trading requires guessing market direction. High-frequency trading, or HFT, relies on statistical certainty across thousands of tiny price movements, too fast for any human to track. Because evaluation stages have tight time limits and aggressive profit targets, solo quants deploy HFT bots to exploit micro-inefficiencies. These algorithms can pass a challenge in minutes by securing hundreds of guaranteed wins without ever taking a directional risk on market sentiment. This network map shows how the AI scans the prices of the exact same asset across 5 different prop firm servers. It highlights a 1 millisecond delay on a single node, locating a pricing glitch that generates a guaranteed 1 to 2 pip win. By exploiting delays in technological infrastructure, solo quants bypass the traditional financial risks that sink manual traders during the evaluation phase. The modern solo quant operates as the silent overseer of a vast synchronized network of distributed algorithms working in perfect unison. This chart visualizes risk-adjusted returns. It compares a high volume of frequent tiny red bars, strictly capped 0.5% losses, against a smaller number of massive green bars representing 3% wins. Because risk is managed, an algorithm winning 40% still generates consistent profits. To increase their odds, quants use an ensemble strategy. They run multiple independent algorithms at the same time, treating the different trading signals like a voting system. If a single algorithm exceeds its Monte Carlo drawdown limits, you bench it. But if the bot analyzing volume, the bot reading price action, and the bot trading mean reversion all fire the exact same buy signal, you multiply your leverage and press heavier on the trade. Prop firm challenges are built to expose human flaws. To win, you have to step away from the charts, stop being the trader, and start being the owner of the math.